The Federal Reserve held interest rates unchanged on Wednesday. That part was not a surprise. Markets had priced in a hold at near 100% probability. 3 consecutive pauses since the start of the year. The Fed's benchmark rate sits where it has sat since January, while Donald Trump's demands for cuts have grown louder by the week. What happened after the decision was something else entirely. Jerome Powell announced he is staying on the Federal Reserve Board. Not as chair, his term in that role ends in May, but as a board member. Weeks ago, Powell had indicated he intended to leave the board entirely, citing an ongoing inquiry into building renovation contracts at the Fed. On Wednesday, he reversed that. There are, he said, remaining steps in the process he feels compelled to see through. The UK's FTSE 350 had spent most of Wednesday in cautious directory. Oil prices continue to weigh on sentiment as the Iran war keeps the Strait of Hormuz under pressure, and energy costs remain roughly 50% higher than before the conflict began. The Guardian's editorial board ran a piece titled, "Whatever Importers Pay, the Price of Fossil Fuels is Too High," capturing the mood in London as well as anywhere. Meanwhile, Rachel Reeves was defending her record as chancellor against cabinet reshuffle rumors, and her own housing and housing ministers publicly derided her reported plan for a year-long private rent freeze within 48 hours of it leaking. Senior UK ministers deride Rachel Reeves' reported plan, the Guardian headline read. No 10 rolled it out by nightfall. Into this already unsettled backdrop came the Powell news from Washington, and for UK gilt and currency markets, Washington's central bank drama is never background noise.
Here is what makes the Powell announcement genuinely unusual. The Federal Reserve Board has 7 governor seats. When a chair's term ends, they can remain on the board as a regular governor, serving out the remainder of what is typically a 14-year term. Powell was first appointed to the board in 2012. That term runs until January 2028. Which means if Powell follows through, he will sit at the table in every rate-setting meeting. He will vote. He will dissent if he chooses. And whoever Trump appoints as the next chair will have to govern a room that includes the previous chair, one who has already publicly defied the White House on the question of independence. This is not unprecedented in Fed history. Alan Greenspan briefly remained a governor after his first term as chair, before being reappointed. But the context then was not a sitting president publicly demanding rate cuts and having reportedly explored whether he could legally fire the Fed chair. The German financial press framed Wednesday's decision with a phrase worth noting, "Der Geruch von Stagflation," the smell of stagflation. That framing is significant because it reflects what professional investors in Europe are pricing as the risk scenario, not just a Fed that moves too slowly, but a Fed that becomes politically compromised at the precise moment a difficult call needs to be made. The market read on Powell's board decision is a two-sided problem. On one side, continuity. A vote from Powell signals to gilt markets and sterling dollar positioning that the institution's hawkish instinct has not entirely left the building. On the other side, friction. A board that includes the former chair creates the conditions for visible internal conflict, and visible internal Fed conflict has historically been a source of volatility, not stability. The third consecutive hold was already priced. What was not priced was the possibility that the post-May Fed looks like 2 centers of gravity.
The case for calm is straightforward. Powell on the board is a known quantity. Markets spent 3 years watching him hold the line under pressure. His presence as governor, not chair, could act as a credibility anchor during the transition. If Trump's nominee for chair is perceived as more politically pliable, having Powell in the room voting provides a partial offset. Field yields and sterling would benefit from that read if it holds. The case for disruption runs the other way. A former chair who disagrees with the current chair's direction does not stay quiet. The institutional norms of the Fed do not require it. If the rate path diverges from what Powell would have chosen, dissents become public record. A string of Powell dissents in late 2026 or 2027 would send a signal that markets cannot ignore. The person who ran the Fed for 8 years thinks the current leadership is making a mistake. The Schroders Capital announcement out of the city on Wednesday adds one more layer of context for UK investors. Over £100 million of local government pension money moved into early-stage British tech companies through the UK Innovation LTAF, backing Wave, the autonomous vehicle company, and 11 Labs. This is the second close of a structure explicitly designed to redirect pension capital toward domestic UK growth. The headline on that story is optimistic. The subtext is that UK growth needs structural capital redirection because the organic investment conditions are not generating it on their own, a point that sits uncomfortably alongside the Reeves political turbulence of the same 24 hours. The verification point for all of this is the appointment of the next Fed chair. If Trump names someone before May, before Powell's chair term actually expires, the announcement itself will tell markets everything about how much daylight exists between the incoming chair and Powell's board vote. Watch for that name. If it comes alongside a statement on Fed independence, the two-gravity scenario eases. If it comes without one, the scenario sharpens. The evidence today leans toward an extended period of Fed uncertainty rather than a clean transition, but that lean holds only if Powell's stated reasoning, remaining steps in the process, is the actual reason. What happens if it is not?